All right, good evening, ladies and gentlemen. Well, let's see what we have in store from the market, all right, this week. Yeah. Now, please bear in mind that all forms of trading bears a risk of loss, so you are supposed to know your risk. You are supposed to do your own due diligence before deciding to make any trades or join any trades live in your own accounts. All right. So, before we go into the market updates, let's talk about the market expected trading ranges, right, for this week. Yeah. Now, we have an expected range of about $7.60, right, on the SPY itself. All right, now, so this is done adding the cost, right, of the at the money strikes for both the call options and the put options. All right, now, so this is done by adding the cost of buying an at the money strike call options and an at the money strike put options, right, before the market opens for trading. All right, so once Friday's closing has been established, all right, what you need to do is you need to go out find out, all right, how much it will cost you to buy each side of this at the money strikes. Now, the total cost would actually formulate the range, all right, that the market is expected to trade, right, for this week itself. So the SPY closed at about 694.07 last week. So if you add $7.60 to that, right, it's actually going to give you an upper boundary, an upper range, or you would call it an upper limit, right, of $701.67. Okay, 701.67. Right, on the lower end, right, when you minus $7.60 from the closing price, right, it brings you a number of 686.47. All right, so these are what we see, and these are what we have, right, when it basically comes to the charts. Yeah. Interesting. Okay, now, so with all that said over here, right, the charts are basically showing us and leading us the way, right, in terms of what the market would expect the trading to be looking like, right, or to be determined. All right, so let me set up the indicators. All right, and we can see the lower boundaries kept over here. Right, we can't see the upper boundary, right? But when I expand the time, right, you can start to see it. All right, now, so we actually touched the lower boundary. All right, no, sorry, this was last Friday. All right, now, so the market opened down, okay, but we didn't really push much, right? We could have gone down much further, right, all the way down to 686, which effectively, if you look at it, right, it effectively just erases the whole of last week's gain. Yeah, pretty interesting if you look at how these numbers pan out. Right, if the market does get there, if it hits there, right, it's basically just erasing all the gains that we got from last week because this is a weekly chart. Yeah, okay, and the upper range, right, would make it a very, very stretched state, right, when it comes to the S&P itself. Yeah, now, so one of the reasons why I say it will bring it to a very, very stretched stage, right, is you can imagine that if the, the, the 20-day moving average is actually pretty wide, right? And every time the SPY gets to a very wide stage, right, it would end up reversing or retracing at least towards the 20-day moving average, right? And if it gets worse, right, we could actually retrace all the way back, right, to the 50 as well, right? And we're looking at the weekly charts right now. Retracing all the way back to the 20-day moving average is actually 668. That's pretty bad. That's pretty bad because we're looking at least a 300-point sell-off, right? And right, if the market does correct further, we're looking at 640. That's almost a 500-point correction move, right? Now, you may seem like it sounds a lot, but 500 points is actually only, right, 8% of where the market is, right? And the 8% correction, right, is not considered a severe one yet. Okay, it's not even going to turn the market into a bearish mode, right? It's just still considered as a correction. Yeah. Okay. Now, so with all that said over here, right, this is what the market has planned, okay, in terms of its trading ranges, right? And for those of you who are still new to this idea, right, what it also means is that we can expect, right, most of the trading for the SPY this week itself, right, to fluctuate within this range. Now, we have quite a couple of news coming out this week. we have the CPI number, right? And then we have the whole lawsuit on the Fed Reserve, right, being raised by the Trump administrations, right? We have continued tensions that are going on, right? What else do we have? We have PPI number. We have PPI number that's coming out this week as well. All right, and then we have unemployment claims. All right, yeah, there's quite a lot. Okay, there's really quite a lot of you. Right now, couple that with earnings. Okay, couple that with earnings that is also expected to kickstart this week, right? And usually in the first week, okay, I would believe that it is always the banking stocks that kickstarts the earnings process. So I'm not sure if it's JP Morgan, but Goldman Sachs, let's see. There we go, January 15th. All right, so Goldman Sachs is announcing earnings on January 15th. All right, so that's this week itself, right, in a couple of days. Right, and then we have JP Morgan, right, on January 13th. All right, that's tomorrow. All right, so you can see that JP Morgan is also going to announce earnings tomorrow. All right, and then of course we have things like Citibank, all right, 40, right, we have Wells Fargo, 40, right, and then we have Bank of America, right, on the 14th. So we have a lot of financial stocks, right, or banking stocks, right, that are all scheduled to announce their earnings, right, this week itself, right? So that can actually spook or that can actually spark the market itself in the form of how it basically trades, right? So we've got to pay a little bit attention to what's going on over here because as of right now, okay, you can see very clearly that the market opened down, right, only to kind of totally erased or closed the gap, all right, that the opening did. All right, so right now we are basically consolidating, all right, but this consolidation over here, right, can actually turn out, right, to be what we call a facade, right now. So some of you may not understand what I mean when I say terms like that. Yeah, okay, now. So when I say that this move can actually be a facade, does anybody understand why I say it this way? Because for many common investors, right, when you see the market get down, right? And only to recover fully, right, in the first 30 minutes of the market itself. Right? Would you say that today is potentially a very, very bullish day? How many of you would think this way? This is actually where the undertone of the market, right, actually kicks in right now. So I have this all inside my market summary slide, right? So I'm gonna go through it, all right, and bring it to your attention, okay? Right now, a medium-term range our medium-term range has been broken up, but it has not changed. All right. So what I'm expecting now, all right, is this week, all right, if the market does surge, all right, from Friday's high, okay, we're gonna see a sudden run up. All right, I'll explain why in a minute. Right, but okay, the higher likelihood, right, is for us to reverse what it did last week, right, and then come back into this range. Right, that's basically my expectations over here. Right, so the moment it comes back into this range, right, we'll probably expect it to head back towards the bottom of the range, which is 675. All right, that is the status quo basically. Now, so coming to the reasons of why I say so, right, is pretty much from what the market did last week. Right, so number one, all right, the first thing that the market did last week was we saw a breakout, right, of the consumer staple sector. Right now, so over here, I'm just going to bring out the XLP. Right? And all of you can see this, right? So if you look at the XLP sector, would you say that, right, this is the daily chart right now? We have a very, very clear breakout move of the consumer staple sector. Can all of you see that? Type yes if you agree. Good. All right. Now, and we are seeing consumer staples go from $76, right, to a high of $80 within what, 3 trading sessions. Right now, is that significant? Right now, it may not look significant because this is basically how the stock market has behaved. Yeah. Okay. But if you think about the components of this ETF itself, it's consumer staples. So you're supposed to be talking about stocks like Walmart, stocks like Procter and Gamble, stocks like Colgate and Palmolive, stocks like Coca-Cola, stocks like Pepsi. Those are your consumer staples, right? Things that you buy, things that you consume every single day. Now, this stock, by moving $4 over here, literally moved 5%, right, within the span of three trading sessions. Is that normal for such category of stocks? Is that a normal kind of expectations from such a sector of stocks, everybody? Good, Terence. That's no. Right now, and typically as well, when the market starts going into a frenzy, right? That means when it goes into a frenzy, it start buying consumer staples like what it is doing over here, right? Is that actually bullish for the market, or is that actually considered more as a defensive stance? How would all of you describe this? Yeah. Right. You can't really tell because market has been very bullish last week. Right. So it may be a buy everything kind of syndrome. But right, looking at this move over here, it might actually seem that it could be money, right, being rotated into more defensive sectors. Right. So this is the first one that we see over here. Right. And then the next one that we're seeing, right, is that we also have a breakout of the material sector. Right. Breakout of the material sector. So let's go over here, all right, and let's go to XLB. Now, so if we go to XLB over here, right, this is the material sector, right, which is basically mostly your home builders, right, or things like your Home Depot, right, which is the biggest kind of like home improvement stores in America, right, and you can see that this, right, also kind of went on a rampage, right? And one of the reasons why this went on a rampage was because, right, I think there was news coming out last week that the Fed, I'm not sure is it the Fed, but the government is basically going to pump like I don't know how many $1 billion, right, into Fannie Mae and Freddie Mac, right, into home mortgages. Now, okay, so that basically brought a boost to this particular sector, right, and that's what we're seeing over here, right. So that's the next one. All right, now, next one over here is a breakout of industrials as well. All right, and this is what we see. All right, so we have massive volatility, all right, when it comes to industrial stocks. All right, so we have this big surge over here, only for a big drop, right, and then after that, this three trading candles, which is like basically a recovery, right? But can all of you see a common pattern, right, between XLI, XLP? Yes. All right. Now, so for those of you who are saying yes, can you kind of share with me, all right, what do you think is the pattern that you see, right, from these couple of ETFs that I've been showing you, right? What do you think is the pattern that you're seeing over here? Terence, defensive approach, possibly, all right, possibly, but I wouldn't put a stamp and really say that this is what we see, right? Because at the same time, right, what we see next is that we see super amounts of volatility when it comes to utilities, right? Now, so XLU. So this is the utility ETFs, right? And you can see that we had a massive drop, right, when it comes to utility stocks, right? And we basically have these utility stocks chopping all over the place, right, over the last few trading sessions, right? We have a massive drop, right? And then we have a quiet day, and then we have a gap up, right? And then today it's opening down, right, and reversing again. So there's a lot of choppiness, there's a lot of messiness that's going involved, right, and going around in the markets right now, right? And coupled with that, right, we also have, right, a crazy move in retail stocks, right? But it is waning now. Can you see that? Right. So we had a crazy move in retail stocks, right, that made a breakout, right, or a breakout to a brand new high, right? But now, right, we have to see if it's actually sustainable, right? So one of the trades that we talked about last week was actually Under Armour, right? So Under Armour basically went on a rampage, right? So we were here last week, right? And what we said was we wanted the stock, right, to kind of cool off, right, and come back, possibly towards the 20 or the 50-day moving average, right? And if it bounces from there, okay, then we probably want in, right? But we're definitely not going to chase at these levels, right? And all of you can see why, right? Because whatever big moves you have from here, right, it can be as equally easy to kind of erase it, right, within the day itself. Yeah. Okay. All right. Now, so this is what we have, right? And then I think we have Lululemon today that released their earnings, right? So I think Lululemon kind of released their earnings numbers or sales numbers, something like that. right? And we have a drop on Friday, right? And today it's challenging to bounce, right, off the 20-day moving average. So if it bounces from here, right, it can continue on the uptrend. But if it fails, right, we're probably going to see it come back to the 50-day moving average. All right, so this stock will probably weigh out, right, on how the retail sector, right, is probably going to play. Yeah. Now, so last one, right? So what really pushed the market towards that last Friday's close, right, was really technology, right? Technology kind of finally participated on Friday itself, right? Now, by this, I basically meant, right, stocks like Nvidia, right? Okay, so stocks like Nvidia actually, looks very, very weak, right? Yeah, okay, but on Friday, right, it actually closed unchanged. Yeah, okay, and then we have Meta, right, that actually pushed higher on Friday, right? We had Amazon that's now breaking to new highs, yeah, okay, and then we have Tesla that's a bit weak, right? But on Friday it made a reversal, right, and followed through today, yeah, okay, which is why, right? And Microsoft as well. So this is what we are, seeing when we saw the market push to the new high, all right, and try to close it there on Friday. But it didn't actually manage to do so, right? And that's the interesting thing because, right, if it was meant to be this way, right, then, right, we wouldn't have been seeing this massive sell-off into the close because the market actually lost 695.30, right, down to 694. All right. Okay. Now it basically lost more than 10 points, right, within the last like 30 minutes of trading. Right. So that kind of shows you that traders do not want to hold this high level positions, right, into the weekend. Right now, so if you say it's bullish, I really don't know what you want to say, right? Because I would say that they probably want to close flat, right? That means they don't want to hold any positions at all, right? So coming back to this right now, what am I trying to build at, right? What I'm really trying to build at over here, right, is this. Right? The points we need to focus on this week itself, right, is what early moves is the market going to make, right? Because, right, if the market continues breaking out to a new high from last Friday, right, based on what I've taught all of you last week, can anybody tell me, right, when this market breaks to another new high, right, this week, what does it force the market makers to do once again? Does anybody remember? Right, TY, great. Okay, Scific, you got it right as well. Now, it basically forces these market makers to perform what we call dynamic hedging again. All right, now, so what dynamic hedging means, right, is that if you remember the ranges that I mentioned earlier, right, so if the market breaks out from those range or it breaks out from the current high, right, that was set last week, right, it increases the upside risk for a lot of these option market makers, right? So to kind of control or to kind of cap these upside risks that they have on their accounts, right? They're going to go to the markets and start buying the stock itself, right? And when they start buying the stocks, right, they're going to actually increase the buying side of the volume, right, for the SPY itself, right? So that would actually drive prices higher, if you see what I mean, right? And as they drive these prices higher, right, they can actually suddenly create what we call a short squeeze, right, where there's so much demand, right, but there's not enough supply, right? So in order to be able to buy what they need, right, they're going to end up driving prices very quickly within a short span of time. So that's probably what we saw last week. All right. And if it does so again, that's probably what we're going to see this week as well. Yeah. Okay. So that's number one, scenario number one. Right. Scenario number two, right, is that we could always fall back into the range, right, and then start heading back, right, into the bottom, bottom side of the range again. Now, is it something that's really difficult to achieve? Right. I wouldn't say so. Right. Because for the market to do that, right, all we have to do this week, right, is to trade and come back towards the bottom of this range. And for it to come to the bottom, 693 to 686. So the market will have to lose about $7. Right now, $7 is only 1%. Did you realize that? $7, 70 points, right? It's about 1% of the current market cost. So we are looking at a 1% drop this week on the back of financial stocks announcing their earnings, on the back, right, of multiple economic events, right, that will be released as well. Right? So I'm not saying this will happen, but I'm not saying that this is very difficult, right, to build the case. Right? It can happen anytime. Yeah. Okay. So that's one of the things you pay attention to. Right. And then finally, we have earnings kicking in as well. All right. So thinking about that, right, we may be able to capture or get into maybe one or two earnings trades later into this week on Wednesday and Thursday. Yeah. Right. So depending on how the first few movers of the financial stocks, right, react, right, to their earnings announcement, right, we'll see if we can take maybe one or two earnings trades on the financial stocks, right, before we end off this week.